Hi folks, and welcome back to Meaningful Money. Okay, still here in my field, nothing much more to be said about that. Still got my shades on, hope you don't mind. Hay fever and the sun being right behind the camera means that these are necessary if I'm going to see my notes. Just a one-off, asking the question, what is an ETF? It stands for Exchange Traded Fund, but a bit of a hot topic at the moment, lots of talk about these things on all sorts of sites. So what is an ETF? So I'll answer that in a minute, but before that, as ever, my friends down here in the bottom right, I must give grateful thanks to. That's 7 Investment Management, who continue to sponsor me here on Meaningful Money. Now, ETFs, Exchange Traded Fund. So it's a fund that's traded on the exchange, stock exchange. That could refer to pretty much anything, couldn't it? Any kind of fund, an OIC or a unit trust or investment trust. But it doesn't. It refers to a particular kind of investment. And what they are is they are tracker funds. They aim to track an index of some kind. I'll come back to that in a minute. So they will hold shares, just like an OIC will do. But they are passive investments. So there's no fund manager involved choosing which funds to buy or sell. Instead, they're tracking an index. Now, they've been around since 1993. That's in the US. In Europe, they've only been around since 1999. Thank you to Wikipedia for that almost certain factual knowledge. The structure is unitized, like an OIC. So look back, just search OIC on Meaningful Money. I can't remember what episode number they were, but OICs are pooled investments where you pool your money with everybody else. That means you have more money to invest with as a group, and you can buy and sell lots of different things, but you don't hold the underlying shares. You hold units in the fund. The fund itself owns the shares, all sorts of tax benefits for doing that. So it's a unitized fund. ETFs are like that as well. They're unitized, so you would own units in your ETF. Now, as I say, they're passive investments. They're designed to track a particular index. So let's say, for instance, you wanted to invest in the FTSE 100 shares. You could buy a FTSE 100 ETF, and that ETF would hold the shares in the FTSE 100. The idea being is that it becomes almost like a mini index. It tracks, because it holds the same things, roughly, it will track the index up and down and behave as near to the index as it can. Now, it'll do that, in one of two ways. It will either do it by holding all the shares in its tracker index in the right weights. Okay, that's called replication. It seeks to replicate the index. Or it will do something called representative sampling, which means that anywhere between 80 and 95% of the stocks in the index, the FTSE 100 say, will be held by the tracker fund, the ETF. The balance, the rest, will be derivatives and futures and things, and that can lead to differences in the way that the thing behaves. Whether or not the ETF tracks the index properly or not, or perhaps to put it a better way, how close it gets is called the tracking error. So if it tracks it perfectly, you'd have a tracking error of 0. But that never happens because there's costs involved with buying and selling stuff, so there's always a difference. An ETF will always underperform its index purely on the merit of the fact that it has charges involved with it. But it's designed to get as close as possible. All right, so you're looking for tracking error. You want a very small, narrow tracking error. The benefits, well, they trade every second of the day. That's why they're kind of a hybrid between a fund and a share. So a fund will trade once a day. So you can only buy and sell it at one point or whatever the price is that day. An ETF, on the other hand, will buy and sell and trade all day, every day, every second. So you can buy in and out of them dead easily. You can get access to markets that you might not otherwise be able to. So you may really, really have a desperate need to invest in the Bolivian stock market. But you probably can't do that as a private investor. But you can buy units in a Bolivian stock market ETF, should such a thing exist, which I have no idea whether it does or not. They're very low cost because there's no people involved. They're essentially run by a computer. And because they buy and sell every second of the day, they're very liquid. You can get your money in and out fairly easily. Now, word of warning, ETFs is one thing. They are funds which hold shares, but you can get something called ETCs, or exchange traded commodities. Now these, as the name suggests, rather than holding shares, they're designed to track commodity index. So let's say you wanted to invest in an oil ETF. Well, it may not surprise you to know that the ETF doesn't actually hold barrels of oil. Instead, it will hold futures and derivatives and financial instruments related to the oil price. So while you might expect if the oil price goes up that your ETF will go up with it, it doesn't always happen that way. So you've got to be really careful with ETCs. Make sure you know what's underneath, make sure you're happy with what the ETC actually holds and that you understand it. Don't ever invest in something you don't understand. Okay, I think that's all that you need to know. Just worth looking back. I'll put a link up here, back to episode 37. That's a sort of passive versus active investment video. 37, that's ages ago, nearly 200 videos ago. So I hope that's helpful, but click that one and you'll go straight through to that. Thanks for watching this one. Next time I'm going to look at long-term care trusts. As ever, leave any questions or email me or hit me up on Twitter, whatever. And thanks for watching, and I'll see you next time.